Hello everyone, my name is Majid Rahimi and you're watching the third part of our classical technical analysis course. This video is the second part of our studies about the Dow theory. So if you didn't see the previous part, you can reach this video here. In this video we will continue the principles of the Dow theory, and after knowing all about it, we can see its defects. Major trends of market have three phases in each bull market and bear market. In the bull market, we have these three phases with these features. The first phase, which is called accumulation, starts when the pioneer traders forecast some advance in market. The news is very bad. Everyone is waiting to hear more bad news and they expect worse market. But as some traders are buying the shares of disappointed sellers, they should raise their bids as the volume of the sellings become lower. Public hates the market. Activities are not too much, but the prices started to rise. In the second phase, prices are in a steady advance, and as everyone can see this, more people come to the market and companies' shares are attractive for lots of people. This phase is where technical traders get what they want from market. In the third phase, everyone is in market, boardrooms are full of people, good economic news come from everywhere. This is the time that your friend might ask you what to buy because they see the market very positive. In the last stages of this phase, the whole market speed calms down while the volume is still rising. Small stocks still go up, but greater ones refuse to follow. The bear market has also three phases. The first phase is called distribution. In this phase, wise investors understand that the market is higher than what it should be, and they start selling what they've bought. Public is still active, but they're getting hopeless. The second phase is called panic phase. Prices begin to fall in a very short time because the buyers are rare and sellers are panicked. The volume is very high in this phase. After this phase, and maybe some corrections or sideways, the third phase begins. Selling in this phase is done by whom they bought in panic phase or kept what they have bought before the panic phase. Business news become worse every day. Small companies stock declining price more and more while bigger and valuable stocks refuse to follow. These conditions go on until all bad news is out. Now, after knowing the phases of bull and bear market, you won't be fooled by numbers of great news about business in the third phase of a bull market because you're now a bit wiser than before to be affected by such an attractive atmosphere. We have some principles to confirm any of these trends by looking at charts. The first principle says that the two averages must confirm. What does this mean? Let me explain it to you with an example. Suppose these charts. The first chart is for industrial average and the second one is for rail or transportation average. Suppose that we had a bull market until the point A, and movement from A to B and C to D can be considered as secondary swing by their duration. Now it's time to pay close attention on what happens here. From A to B, both of the averages have retracement and we are waiting for both of them to see a higher level than A to confirm that bull market is still on its way. But as you can see, industrial average could not register a higher price in C point, while rail average could do so. Then the industrial average breaks the lowest price of previous secondary swing in B, and new low level in D point has been registered. This confirmation method says us that we cannot say the market finished its bullish movement because rail average doesn't still confirm the change in trend. As you saw in this example, the Dow theory always have an answer for determining the major trends, which is mostly objective. The next confirmation method is that volume goes with the trend. This means that trading activities tend to rise as prices go in the direction of the current primary trend. If we show it in chart, for example, assume that our primary trend is up, so the volume would increase from B to C. There's a point here I should explain that volume condition is only more evidence for you to be sure that your decisions are right. Real confirmations, as a rule, are only the price movements. Next principle. Lines may substitute for secondaries. What does that mean? For knowing that, first we should know what is a line. In the Dow theory, a line is a sideways movement in one or both averages which lasts at least for 2 or 3 weeks, and prices go up and down within a range of 5%. It's like a horizontal line like C to D in this picture. When we see this, we can consider it as a secondary movement. The next principle is very easy and simple. In the Dow theory, only closing prices are used. So we can see a line chart of close prices to work with the Dow theory. The last principle, which is very important, is that a trend should be assumed to continue in effect until such time as its reversal has been definitely signaled. This principle is very obvious, and as we have talked, after 2 averages confirmation, we can say a new major trend has been started. And this principle says that before that time, we shouldn't consider current primary trend changed. The Dow theory, which we've learned, has proven itself by statistics during a long time. If you have invested $100 buying and holding the averages when the Dow theory signaled and selling it when reversal signal comes, you would have nearly $350,000 back if the period of your investment was from 1897 to 2005. The Dow averages nowadays are not suitable to explain the whole market, and other averages like S&P and Nasdaq can help us to have a better view of whole market. The Dow theory has many traders which use it or at least respect it, but lots of traders consider some defects for it. They say it's too late and a big amount of movement would be lost when the Dow theory signaled the change in primary trend, and also most of our profit would be drawn back by the market when the Dow theory signaled bear market. Yes, it's true, and we will lose those movements, but who else is getting those? Knowing the highest and lowest point of the market is impossible. Some others say that it's not infallible. This is obviously true, but all other technical studies are infallible too. This is because of nature of the market, as you would see by your experiences. Some others say that theory leaves the investor in doubt frequently. This is somehow true and somehow false. The Dow theory has never a point that the major trend is not specified. But the inference in the time when averages do not confirm each other can be dangerous. Another true statement about the Dow theory is that the theory doesn't help the intermediate trend investor. It's obviously true, and if you want to trade intermediate trends, you should follow other techniques, which we will explain in next videos. This video has come to its end. In the next video we are going to talk about important reversal patterns, and we will start to learn how to trade intermediate trends. Share our videos with anyone who you think that might need these videos. Don't forget to subscribe if you're not a subscriber yet. Thank you for watching, have a good time, and bye.